So for requirement 1, we're supposed to calculate expected gross margin if Jaden produces 26,000, 32,500, or 33,800 books. Calculate the gross margin for each level of production. Begin with 26,000 books, then 32,500 books, and lastly 33,800 books. So in order to find our revenue for 26,000 books, we're going to go ahead and multiply our sales from our selling price. So 26,000 books multiplied by our selling price, which is $86 per book. And that's going to give us $2,236,000 per book. So now we want to find our cost of goods sold. So in order to find our cost of goods sold, we're going to multiply our sales per unit from our total cost per unit. So our sales unit is going to be 26,000 books. And our total cost per unit. So in order to find our total cost per unit, we're going to add our fixed overhead rate with our variable production cost. So our fixed overhead rate is $17 per book. And our variable production cost is $56 per book. And that's going to be $73 per book. So 26,000 books times $73 per book, that's going to give us $1,898,000 per book. And that's going to be our cost of goods sold for 26,000 books. So next we want to find our production volume variance. So now we want to find our production volume variance for 26,000 books. So the equation is going to be our fixed production cost minus our fixed overhead rate times our production. So our fixed production cost is given to us. It's going to be $442,000 per semester. So now we want to find our fixed overhead rate, and that's given to us, which is $17 per book. And we're going to multiply that by our number of production, which is 26,000 books. So our production volume variance is going to equal to 0. And we're not going to put favorable or unfavorable since it's 0. So now we want to find our net cost of goods sold. In order to find our net cost of goods sold, we're just going to go ahead and subtract our cost of goods sold from our production volume variance. And that's going to be $1,898,000 per book. Next, we want to find our gross margin. So in order to find our gross margin, we're going to subtract our revenue from our net cost of goods sold. And that's going to give us $338,000 per book. So now we want to find our revenue for 32,500 books. Our revenue is going to be the same since 26,000 books is our budgeted amount. And our cost of goods sold is also going to be the same for 32,500 books. Okay, so now we want to find our production volume variance for 32,500 books. So if you remember when we found our production volume variance for 26,000 books, it's the same equation for 32,500. So our number of books is 32,500. So our fixed production cost is going to be the same, which is $442,000 per semester. Our fixed overhead rate is the same, which is $17 per book. But our number of production is different. It's going to be 32,500 books. So once we calculate that, that's going to give us $110,500. So this is going to be our production volume variance for 32,500 books. So now we want to calculate our net cost of goods sold. So in order to do that, we're going to subtract our cost of goods sold with our production volume variance, and that's going to give us $1,787,500. So in order to find our gross margin, we're gonna do revenue minus our net cost of goods sold, and that's gonna give us $448,500. Also, for 32,500 books, our production volume variance is going to be favorable. The reason why it's favorable is because the more amount of books we produce, the more money we are making. So in order to find revenue for 33,800 books, it's the same as our 26,000 books revenue. And our cost of goods sold is going to be the same also. So just like what we did for our 32,500 books, we're going to do the same for our 33,800 books. So the number of books is 33,800. So our fixed production cost stays the same, which is $442,000 per book per semester. And then our fixed overhead rate is $17 per book. And the number of production is 33,800 books. And once we calculate that, that's going to give us $132,600 per book. So that's going to be our production volume variance for 33,800 books. And it's also going to be favorable since we are making more money from producing more books. So our net cost of goods sold is our cost of goods sold minus our production volume variance, and that's going to be $1,765,400. And to find our gross margin, it's going to be revenue minus our net cost of goods sold, and that's going to give us $470,600. Okay, so for requirement number 2, it says calculate ending inventory in units and in dollars for each production level. So our beginning inventory is actually given to us, and it's going to be 0. And our production is going to be 26,000 books. And our number of sales is also 26,000 books. So in order to find our ending inventory, we're just going to subtract our production from sales, which is 0. Now, in order to find our cost of per book, we're going to add our fixed overhead rate with our variable production costs. So 17 plus $56 per book, that's going to be $73. And once we do that, we're going to multiply our ending inventory from our cost of book per book in order to find our cost of ending inventory. And that's going to be 0. So now we want to find our beginning inventory for 32,500 books. So our beginning inventory is also going to be 0. And our number of production is going to be 32,500 books. And our sales stays the same, which is 26,000 books. And we're going to go ahead and subtract the 2, our production from our sales. And that's going to be 6,500 books. And our cost per book stays the same, which is $73 per book. And we're going to multiply the 2. So our ending inventory multiplied by our cost per book, that's going to be $474,500. And for 33,800 books, our beginning inventory stays the same, which is 0. And our production changes, and it's going to be 33,800. And our sales also stays the same, and that is 26,000. And so in order to find our ending inventory, we're going to subtract our production from our sales, and that's going to give us 7,800 books. And our cost of books stays the same, which is $73 per book. And we're going to multiply our ending inventory from our cost of book in order to find our cost of ending inventory. And that's going to give us $569,400. So for requirement 3, as asked us, managers who are paid a bonus that is function of gross margin may be inspired to produce a product in excess of demand to maximize their own bonus. There are metrics to discourage managers from producing products in excess of demand. Do you think the following metrics will accomplish the objective? Show your work. So for A, it says incorporate a charge of 15% of the cost of ending inventory as an expense for evaluating the manager. So if you remember, for 26,000 books, we actually calculated our gross margin for requirement number 2. So our gross margin for 26,000 books is going to be $338,000. And in order to find our ending inventory, we're going to multiply our cost of ending inventory by 15%, and that's going to be 0. So our adjusted gross margin is going to be $338,000. So our gross margin for 32,500 books, that's going to be $448,500. So in order to find our ending inventory charge, we're going to multiply 400 and our cost of ending inventory, which is $474,500 from 15%, and that's going to be $71,175. So to find our adjusted gross margin, we're going to subtract our gross margin from our ending inventory charge, and that's going to be $377,325. And our gross margin for 33,800 books is $470,600. And our ending inventory charge, we're going to find that by multiplying our cost of ending inventory, which is $569,400 from 15%. And that's going to give us $85,410. And we're going to subtract the 2 in order to find our adjusted gross margin, and that's going to be $385,190. And that is how you find your adjusted gross margin. So our adjusting for ending inventory does to some degree mitigate the increase in inventory associated with excess production. Therefore, it may be difficult to mechanically compensate for all of the increased income. In addition, it does nothing to hold the manager responsible for the poor decisions from the organization's standpoint. Now for B, it says, include non-financial measurements when evaluating management and rewarding performance. One non-financial measure is to compute the excess production ratio. Determine the formula, then compute the ratio of each production level. So in order to find our excess production ratio, we're going to divide our production units from our sales units. So for a number of books, which is 26,000 books, our production unit is 26,000, and our sales unit is 26,000. And that gives us 1. And our number of books for 32,500, our production unit is 32,500, divided by our sales unit, which is 26,000, and that gives us 1.25. And the same goes for our number of books, which of 33,800. So our production units is 33,800 divided by our sales unit, which is 26,000, and that gives us 1.3. Now it says a ratio of ending inventory to beginning inventory is not possible since beginning inventory was 0. A change in inventory level can be used instead. The non-financial measures must be incorporated into the reward function of the manager to be useful.